Very good. All right, well, let's jump in here. For those of you guys that have never seen this before, we try and do these Wednesdays and we try and bring value to you guys. And so today we're going to talk about something that not everybody hears about, probably hasn't been very prevalent in the last, 10 years. But it's going to start to be more prevalent as we move into this higher interest rate market at 6.5%, 7%-ish, whatever they are. And our lender extraordinaire, Miss Stacy Medinas, is not on with us, so she can't give us today's current rates. But we're going to talk about assumable mortgages. Does everybody know what an assumable mortgage is?
Yes.
Yes. Okay. Arvid, what you got? Is that just a yes?
Yeah.
Okay. Gotcha.
We did one about 2 months ago.
Okay, cool.
A VA that was assumable at, I think it was
2%.
2.5%.
Fantastic. All right. We have also another scenario here. Tammy in our office just did an assumable. So I'm going to get to that a little bit later. I want to talk about assumables first, and then I'm going to ask you guys about your specific circumstance, like how it happened, how it occurred, all that stuff. But right now I'm going to share my screen and kind of go over a couple things with you guys. So I'm going to flip a couple of screens. I'm going to give you guys some ideas. And then I'm going to show you guys how I do my assumable. So how to put more deals into escrow with assumable loans. First and foremost, you got to learn how to find those assumable loans, whether that's in the MLS or if you're calling your favorite title rep to do some research. So everybody knows that in MLS, there is a way for you, if you have a client seller that is looking or is going to sell their property and it's assumable, you can put a tab under terms that says assumable. That way people will know that it's out there. But here's the thing, not every agent understands even what assumable loans are or the huge benefit to their seller or to possibly a buyer. So we're going to go through that. So you guys obviously can call your title rep as well and find out who has assumable loans. So the two main assumable loans are going to be FHA and VA. Every once in a while, you'll find someone that has a hard money loan or maybe a seller carryback that also might be assumable. That's not something we deal with on a regular basis, but it's something that you can possibly have out there. So we're going to talk about how to have a discussion with the seller and what the benefits are to them, how to have a discussion with your buyer and the benefits to them. And then we're going to teach you guys how to run calculations. So every seen or used mortgagecalculator.org. Yes. So write that down, save that. Kelly, also this course for anybody that has, they feel like, hey, this was great information. Gary's the greatest. Yes, you guys will all think that by the end of this. And I want to share this with, part of our team, another agent. Kelly has this all recording, right? We are recording, Kelly. Okay. And then they go out in our Friday messaging to the team and they are on our YouTube channel. So just FYI, if you don't get it or there's information you want to go back and review later, you'll be able to do that. So, all right. So how to search the MLS for assumable loans. You can do a standard search and then the secondary tab under terms. And I'm going to show you guys this in MLS. So I'm going to hop into MLS and you guys and of course, you guys in Arizona, your MLS is slightly different than ours, but I just do a standard search and I'll just put in here that I want residential and anything that's currently active. You could also look at expired and canceled for people that had thought to sell their property and it was assumable and then they decided not to sell it. It might be a way for you guys to go out and get listings. So just something to think about. So I don't put in a price point. Only thing I do is I put in the cities or the counties that I'm looking at. So I'm going to look at Sac and Placer today. And then I go here to additional criteria and I go all the way down to the bottom under terms. And if I'm moving too fast, everybody's getting dizzy, I apologize. Take a Valium or something, it'll calm me down, right? So, all right, under terms, there is a box right here for assumable. So you click include, hit OK, and then I'm going to hit search. So there's only going to be about 5 or 6. So these 5 properties supposedly have assumable loans. Now, I have been researching this for a couple of weeks. I knew I was going to do this talk. And there are agents that think their loans are assumable and they're actually not. So you have to look in and do a little further research. So if I look at this property, and Camden is one of the ones I've actually looking at, this is my scenario today. So VA assumable loan with loan interest rate of 4.125, which You guys, Arvid and Kay said yours was 2.5. I know a couple VA people that have 2.25, which is fantastic, but still 4% versus today's 7% is pretty decent, right?
Yes.
So if you go down here, you'll see that they have assumable cash. Like I said, for you guys in Arizona, your MLS is probably a little different. I then go to the tax records, which is this is where our tax record connection is. And then I verify that it is in fact an assumable and it is in fact VA. So you'll see right here. So this is they bought this in March of 22 and they have a $518,000 loan amount. It is a VA. So we need a VA's assumable. So quickly on that, VA is assumable by anyone. You do not have to be a veteran to assume a veteran loan.
Oh,
But the caveat is this: if that veteran wants to use their VA benefit again, they cannot, because that VA loan is still tied to them.
Yep.
So unless your new client is a veteran and has a DD-214 and whatever other, there's another form, I can't remember what it is, that shows they're a veteran, they will then take the entire veteran benefit over to them because they're a veteran and would allow that other veteran to go ahead and move on and use their VA benefit again. We have one of our agents, Melissa Roberts, she was one of our assistants. They are selling their house here and they're moving to Indiana. He has a VA loan. He's in El Dorado County. And so his is like 2.5 or 2.25, but his loan is only 300 and we're selling their house for 450. So someone needs to come in with that difference, 150, which for a lot of people may not make a lot of sense. But for this one, they're at 518 at 4 and an eighth. So this might make sense because they're selling this house for 529. So they've had the loan for a year. They might have paid off $2,000, $3,000, $5,000. So it might be 515, 512. So someone needs to come in with about 17,000, which is about the 3% down that we would have. Cheryl, do you have a question?
well, you would want to, when you do your search criteria.
Yep.
You don't want to go back too far because then they'll have more equity that, which is cash.
Yeah.
So you gotta be careful.
Yeah. So Cheryl's question or statement is, if you go back further, people may have a bigger equity position. And like I said, for Melissa, that's the case. They got their loan 3 years ago. They've been in their house for 8 years. They only refied to a percentage. So that's why that 150,000 is there. And also some people are buying and refinancing into their economy of a year ago to get that low rate, but they may have done a rate and term. So you're right. They might have a huge equity position. So that may not be a viable thing for your client. Now, I have a client who just sold in Elk Grove, or actually we're selling in Campus Commons, which is near Sac State. He has, after that property sells, he's going to have 100,000 down. So I may be able to find a VA or FHA loan that has that $100,000 equity position because he has the ability to put that money down. So it is something to state. So Arvid and Kay, you guys have a quick question? I see.
Yes, can a seller refuse a buyer that wants to assume the VA loan, but he's not a veteran because the seller wants to buy another house and use the VA loan benefit?
Yeah, 100%. Seller always has the right to reject an offer, and it would be based on the terms because I want to use this loan again. Therefore, I'm rejecting your specific terms. Yeah, 100%.
Great.
Great question. So
You get a loan on the balance.
So yeah, so that's the other question. So you have a couple of things that you can go through this process with. If someone has a huge equity position, 100,000, can you look at a credit union that would do a second behind it? Could you ask the seller to carry the note? There's lots of things you can do. We're going to have to get creative. I think we'll see more of that as we move forward. But like right now, I think the timing will be such that there will be people be able to get in for like that 3%. And the other thing is you got to realize that 3% has to cover escrow, title, any transfer you have, but also it has to cover agent commissions. So if your client is like, oh, I was going to use down payment assistance and get in for $3,000, this may not be something that they can do unless the seller says, hey, I'm actually pretty close to like dead even for what my appraisal is and what I owe. And we're willing to pay the $20,000 of commissions, to close this thing out and get it out from, under us. Okay. Another thing to note is FHA. For 5 years, the previous buyer or owner is on the hook for the loan. So if your new buyer goes in and in 2 years defaults, it will screw up the credit of the original person.
Oh, that's a big.
It is a biggie. So something to think about, something to kind of put your thought process into. So when you're talking to your sellers, help them understand, especially for FHA. All right.
Is VA the same?
I don't exactly know because assumables have been around for years. FHA and VA have been assumable since the dawn of time that I'm aware of. It's been built into them. We have never really had the opportunity to use assumables the 20 years I've been in real estate because markets have always been going up. And at that, in the 6, 7, 8 crash, they dove so much down that no one would assume an FHA loan because the values had dropped $100,000. So it was better to do a short sale at that time. So I'm going to show you guys this side by side. So this property on Camden, the one I happened to have up a second ago, this is a side by side comparison. So this payment at 4% interest rate, which is 4.125, if you did a 520 purchase or what their purchase price is, 529, and you assumed their loan and came in with about 3% down, which is 15 grand. I literally took these and just mirrored them. So if you have a question about how I did my calculations, let me know. So if someone assumed that loan and had that 3% down, they would ultimately be paying about $3,000 a month for that $539,000 house, right? And obviously you can adjust and you can negotiate what that purchase price is. If they bought it in today's economy at that same price for 7% interest rate, their payment will be $39.45. You notice that it is a $900 difference. So it's huge for your current buyers. And I'm going to make this note because I'm sure some lenders will watch this. If you have a great lender that you work with and your person is pre-approved with that lender, don't go steal that person from that lender and go and try and find an assumable, because ultimately your lender loses out. The lender is not involved in the assumable. So if Stacy Medina's, one of our wonderful people, or Jason Thompson, or whoever we have, Michael Tennant, is your loan officer and a specific buyer to you, don't go and steal them because they ultimately get nothing. Now you guys can work something out on the backside if they gave you that deal. The cost to do an assumable is about $1,500. That's what I've heard. I've seen it as low as $1,200. I've seen it about $2,000, but I find that the average is about $15,000. So Arvid and Kay, you guys just did one. What was the cost on your assumable? Do you remember?
I don't remember, but he saved 15,000 a year on interest. So
we're going to get to that in a second. Good job.
okay, and so we offered we were competing with a regular loan,
Awesome.
or cash even, and so we offered. I think we offered almost 20,000 over to get it, but he saved 15 of it the first year.
Yep. Awesome. Perfect. Tammy, do you know how much your person was for the assumable portion?
I don't know.
Okay.
I didn't get any of that information.
That's right. It would be on your net sheet, or it should be.
Okay.
So something for you guys to look at. So that is great information. You guys save 15,000. So here's what I want to go through. The PMI payments stay the same. The down payment right here is 15,000, 3%. But realistically, if you paid this off in 30 years, on the left-hand side, the 4%, the interest paid is $348,000. The interest on the 7% is $676,000. So your client, should they hold this loan for 30 years, saves $300,000 in interest.
That's great.
So
That's another purchase.
that's what Arvid and Kay were saying was their person saving that $900 a month over that 12 months is $11,000. And then over the course of it, so it might make sense to maybe offer a little bit more on your purchase price and then come in with that difference. The other thing you could do is you could ask the seller to do a carryback of, say, I don't know, $15,000. That way you're not having to come out of pocket for it right now at the close. And you say, listen, over the next 3 years, I'll pay you $300 a month for you guys, for the seller, as a little added bonus. So their payment's now not $3,000, it's $3,300 for 3 years. And then it drops down to the $3,000. So another way you could work it out. Another way you guys can work this out from an agent standpoint, because my wife and I were talking about this, is if there's not enough money from the down payment for them to pay all the commissions. You as the agent can write a note against the property and have them pay you $200 a month for 2 or 3 years so that you make your $8,000 or $10,000 commission. So what would be nice is you don't get that chunk at once, but hey, I'm going to get a commission over the next 2 or 3 years, a couple $100. Well, if you do 5 or 10 of these, you're getting a nice little chunk of money for a period of time. So just something to think about. You guys can work that out. And you can drop a note, escrow can drop a note and deed of trust for you as a part of your closing, and they will do it usually for free. Just FYI. Cheryl has a question.
Yeah, I had to step out. I apologize.
No worries.
So where did you come up with the 3%?
The 3% down payment,
Yeah,
a conventional 97% loan, whether it be a 3% down, or if it was an FHA, it'd be 3.5% down. I just tried to make the numbers the same.
so they have to come in with the cash to make up the difference, right?
Or the seller can,
Between what the loan is and between what they have it listed for, right?
correct? Yep.
So the buyer has to come in with that.
Or the seller can.
Wow.
Or they get a second mortgage or the
Or
seller
they can
gives
get a
them
second
notes.
mortgage,
Yeah, you
whatever.
borrow from
So-
grandma, grandpa, borrow from your 401k. There's lots of ways that people don't think originally to get that money.
Where does this 3% go?
It would go into escrow
Just
to help pay commissions and escrow, title, and transfer taxes, all those things.
Oh, okay.
Yep.
Because it could be a little more, right?
It could be, yes. I use a very standard. This is a very basic. So I tried to just make it equal so you guys could literally just see the breakdown side by side.
Because, or you bring in less cash and the seller still pays the commission.
Possibly, yeah. Did you guys all hear Cheryl's question in our interaction? I just want to make sure. Good. All right, Arvin and Kate, you have another question?
We had one where it wasn't selling very well. It was about a $650,000 house. And a buyer came in and said, we're interested in the house, but here's what I would propose. We'll come up with $400,000 cash. We're gonna sell our house, but we don't know how long it'll take. So we'd like the owner to carry back the remainder. I think it was 250,000 at 5% at the maximum of 1 year.
Yep.
And so I talked to the seller and he said, absolutely, I'm free and clear. Sounds like they are, except for they need to sell their house.
Yep.
So it would be I can't get more than 5% on my money anyway during that time. So I'd be glad to do it because he said, but then we would put some type of lien on the house for the balance. We never got that far because they decided not to buy the house.
Gotcha.
But-
Yeah. In California, we can do seller financing, and our escrow and title companies with a seller financing addendum to our car contract will draw up the note and deed of trust for us and do all the calculations. Just an FYI, it can be done. Yep. All right, so I'm gonna flip out of here real quick. I want to go back to my Word doc. So we talked about standard search. Another thing I would tell for you guys to do is, sorry, I want to go here, is who has a buyer looking somewhere right now? I'm going to do a standard search. What do you have, Tammy?
Yeah, we got leaks broken and 5 bed.
Okay, so Lincoln.
Pool. 33,000 square feet.
42. I'm just gonna 2,500 square feet. I'm gonna go there and see what we got.
That's standard one.
So, and obviously I want to make sure you guys all aware is this will not work on a new home build because there is no current loan on it. So I was just pulling this up, and of course, Meritage is the first one that's there. So there, Tammy said 4.3, 3,000 square feet. I'm sorry, she said 5.3. This right here, 974, comes close. So what you can do, because like I said, not every agent fully understands this, is you can go through, create the search you have for your clients, and then go to the tax records and pull up what type of loan is on this property. So this right here has a conventional loan for 335,000. It may not work. Your clients need to come with 600 grand, but you can go through this process and then call the agent and say, hey, did you know that your clients have a VA loan for 750,000 your house is 800,000. My clients have 50,000 down. My clients would like to assume that loan. And you could walk through that process with an agent. So I have a client looking in Elk Grove, and I called an agent yesterday and said, hey, or I sent her a text message, and she said, you know what, we just got into escrow, but my clients would have absolutely looked at that. So my client currently, based on today's rates with 100,000 down, is qualified at like 525. That house was 600,000, but the interest rate was 3%. So his payment would have been within like $100 of what we were going to be at. So he could buy a lot more house for the same amount of payments. You know?
Does anyone, so are these getting done? At first I heard that they were really taking it.
So great question. And we're not quite there yet, but I want to answer Cheryl's question. Are they getting done? Yes. Arvin and Kay did one, they just mentioned, and Tammy just did one. So that's 2 people that within the 12 people that are here listening to this. So 20% of the room has seen them and been a part of one.
So does this, who does the qualification?
So it's
Like
just
the servicer?
the servicing company. Yes. So the servicing company. So Tammy was Carrington. She said it was not easy. I'm going to tell you guys, this is not super easy. Like you're dealing with your loan officer here in Roseville, Stacy Medinas, or whoever, right? And say, oh, it's easy. You're pre-approved. We got the appraisal done. It's done in 21 days. This is probably a 60-day process, maybe even as much as 90. So you got to make everybody aware of that up front. Absolutely. Tammy, how long did yours take?
Ours was 45 days.
Okay. And Arvin and Kay, how long did your deal for your assumption take?
It was almost 4 months, but it was acceptable to both of them.
Okay.
But we couldn't believe, because you could get a VA loan in 6 weeks, but
Yeah.
the Assumable, they said we have such a backlog of people that want to do these that we just can't get to them that fast.
Exactly.
And that's what they said to me too, but it
Okay.
took them literally 21 days to respond, even
Gotcha.
the concierge to respond to us. And
Gotcha.
so I was like, I'm gonna ride their curtail,
Gotcha.
be the squeaky wheel until it gets done. And
Gotcha.
they actually closed 1 week before they said they were going to.
Awesome.
So that was
Awesome.
good. Yeah.
Very good. I'm gonna just get back to my screen share. So that is the thing. You guys have got to be realizing that the escrow company can help you guys and push. The seller or listing agent's going to have to help push. The buyer and the buyer's agent are going to all have to push together. If you guys all remember what short sales did back in 2007 through 10, 11, 12, it was a year to do them. And then it got down to about 3 or 4 months people could get them done in. So it's going to be the very similar thing. It's going to be 3, 4, 5 months maybe now. And by the time they've got their systems down, it'll probably be, less than 60 days, a lot closer to your 45 days.
Backlogged really bad.
Gotcha.
They were really backlogged.
So the servicers will start to take some of their processing and underwriting people, and they will move them over to a department specifically for Assumable, which will help to speed up that process and make it a little bit smoother. Yeah. So real quick, also the servicer does not need to allow the Assumable, just so you guys know. They have the ability to kick it out. Usually it's based on qualifications. It's not, we just don't want to do it. It would be something to do with qualifications. So if you have someone that's 53% debt ratio and they only have a 619 credit score, and they've got, $2,000 in the bank, and this is gonna, just stretch them to the max, they may decline yours. So just something for you guys to think about. All right. So I want to show you guys mortgage calculator. Like I said, this is mortgagecalculator.org, and it's just set up here, and it's super easy to use. Save that under your, tabs. All you do is put in the home value here. So I'm going to use the one that I used earlier at 520,000. And I did a down payment of a percentage, which was 3. That's how I got my numbers. I did it at 7. The taxes, I estimated at 5,000. Obviously, if it's a VA, there's going to be no PMI. If it's an FHA, there is going to be PMI. This one has none, is a VA, so there is no PMI. You got to realize if you've got HOA, do not hit compare loan types. Go to the bottom and hit calculate. That's how it will pull these numbers up over on the side here. And you'll see that's at 3855. I think ours had HOA. That's why mine was a little higher. But I want you guys to think about this. If you have a client who is qualified at a payment that they qualify for, say at $3,800 on a 7%, when you move that to 4%, it brings them down to 2908, right? So you got to think about this now. If they're looking at a payment, you have two things you can tell them on. I can get you a lower payment, which puts you guys in a much safer place. Or if they're right on the cusp, you can say, hey, what about if we looked at a $600,000 house? Because now the payment's $3,200. So you can now start to play with what they can assume based on their payment amount. And that'll be something you guys have to kind of play with and jockey around with. But especially for those folks that are right now going, hey, I'm only qualified at 350. You know, we all have those. They make, you know, $4,500. It's it's a young couple getting started, or it's a single person that's, you know, I only have this much money. Okay, well, if $2,500 is your payment, let's find a 3% interest rate that will get you to that $2,500 payment, because it might buy them a $400,000 house or a 425. When we talked on Monday, Zach, I'm pointing at Zach, and so was Audrey, is he's like, oh, I have these friends and they're really awesome, and we thought they were going to qualify for this much, and they were like, oh, we don't qualify for that much. And I mentioned Assumable in our Monday morning accountability group, and that's what led me to make sure I pushed to have this for you guys today, because those folks with $10,000 down or so might be able to find a $350,000 or $400,000 house that has that same payment amount.
Yeah.
So
yeah,
it sucks for your lender that might lose that deal. Hopefully that lender didn't give you that deal.
no,
So
not that one.
all right. Any other questions? Cheryl's got one.
So, on the FHA front.
Yep.
Where are we there? Are we seeing those go to-
Mhm. Yeah.
I got one.
Yeah, hers was FHA. Sorry, we didn't state that. Yeah. Arvid's was a VA and Tammy's was FHA. Yep. Yeah. So
And they got to buy it 450, asking was 465, they offered 450, they accepted, and they didn't even count them.
Gotcha.
Oh.
I know.
Yeah. So great thing that Tammy was just talking about.
Oh.
You guys have to think about the negotiation standpoint on these.
Carrington, I don't know if you've ever
Oh.
heard of them.
Yeah.
Carrington's been around a while. I sold REOs for them. So
Okay, so that was
yeah.
your pitch.
real quick, actually, Kelly, you had a question too. I want to make sure I answered it.
It just seems to me, I mean, I know that there's the need to keep the relationship with the lender. But if you have an opportunity to put your clients in a better scenario, it seems like that would be the better thing.
Sure.
For my fiduciary duty
100%.
to be able to do that.
It is. My main thing is not if you have a lender that you're working with, it's if a lender happened to give you the deal. And now you're going to take that lender that gave you a buyer and you're like, hey, I'm going to send them over here and you get nothing. That's what I was trying to state. And we all know lenders don't always give us a bunch of deals, but I know that you guys have gotten a deal from your lender. I've gotten a deal from my lender. So I'm just saying, if they gave you that deal, you may need to work out something with them. Like, hey, I found them this great deal. That's assumable at 3%. I'll take a portion of my commission and pay you for your work, your time, or I'll make sure that my next buyer goes to you. There's another way to try and,
Control.
Yeah. No, you can't. No, you can't. So
Another question.
sure, Cheryl.
So I don't use this, I have a calculator that you use, the mortgage calculator. So is there a way to find out what the PMI would be? Or the mortgage, the mortgage insurance?
Yeah, it's right in here. So if I put in here 0.5, it will calculate the PMI. It just comes out with its own little thing.
Oh, that's.
Where'd it
Oh,
go?
you put it under HOA?
Oh, shoot, sorry, my bad. 0.5 for PMI, not HOA. No HOAs are 0.5s.
Oh, okay, so you're just using that figure for.
There's your PMI. It's 240, 250. So 0.5, yeah. And 0.5 is the generic
Okay.
rate. You want to find out what the exact PMI is on that property. Because if it's FHA, it might be a little higher, it might be 0.7. If someone put down 5 or 10%, it might be down lower. USDA is also a government loan. I'm pretty confident they are assumable, where there's like 0.1. It's really close to a VA loan. The PMI is like $50 or $60 a month for USDA loans. All right. So any other questions from our folks out there? Annette raising her hand. What you got for us, Annette?
Okay, say we have the listing and the sellers have an assumable FHA loan.
Yep.
What's if we get a call from a buyer's agent saying they're interested in making an offer, what's the process? Do we just put the buyer's agent in touch with the mortgage company or servicer?
So very first, you have to be into contract, that the seller is willing to accept that, and the buyer likes the terms of the current loan, right? So real quick, just a little caveat or a little side note is, if somebody got a loan in the last 6 months, their rate might be 6%. And if you buy today, it's 7%, right? Well, that 1% may not make a huge difference, but obviously someone's got a 3% rate, they're definitely going to want that. So just something to think about. So when the buyer's agent calls you, you should be able to say, hey, the rate is X. And yes, they're all assumable, but I mean, does a 6% rate when I can get a 6.25 maybe make that much difference? It's possible. I mean, if they're getting down payment assistance or something like that, it might, that 0.25% interest rate might make more sense to use the down payment assistance, and payment might be $100 difference. It might be minimal. So the seller has to agree to the terms. You guys have to have an executed contract. Then you would open up escrow, and I would tell them to hang tight on inspections. This is my personal thing. Whether you're buyer or seller side, I would still probably say, let's hang tight on inspections to make sure we can get the servicer to get engaged with us. And so you got to also remember is the buyer that's calling in should have an FHA approval already with somebody else, so that we know what their debt ratios are, and what their credit score is. Because if not, you're kind of going into this blind. They go, oh yeah, I've got a pre-approval and I want to get an assumable loan. Well, if they've got a 580 credit score and their debt ratio is 57, they really aren't approved. I would say, get your favorite lender to get them really run through the DU process, to make sure you know what you're dealing with.
Can I say something there?
Hang on one second. Arvin and Kay had a question first.
The point you made about assumable VA loans to anybody, when the realtor on the listing said that, I challenged her on it. I said, are you sure it's available to anybody, not just a vet? She said, well, that's what the seller told me, but I'll check on it. So I called a lender, and they confirmed what I thought was that you can't do it unless you're a vet. But then I remembered back in 86, I had a VA loan, and I sold it to someone, and he assumed the loan, wasn't a vet, and I was on that loan for 30 years. And I just got off it in 16, and I got another VA loan on my house now.
Yes, so that is the thing for the VA. Like I said, you're on that. Now we're all hoping that at some point the rates will go back down and it will make sense to refi out of that loan. Or most people don't, at least in California, we find that 7 to 10 years is kind of the standard that we stay in our houses. People move, change, adjust life circumstances, whatever. Hopefully that, they would sell, refi, do something that changed it, that would let the veteran out of that property or out of that loan. Another thing is look for veterans that are on the older side that are like, I'm really not going to go and get, another veteran loan. My dad's 76. He's a veteran as well. If he had a loan and somebody called to say, hey, I want to assume that, I'd be like, yeah, let's do it. Because my dad's never going to use the VA loan again in his lifetime.
Yeah.
So just things to think about and watch this through. So Tammy, you had a question.
Or a statement. I wanted to say that, they never did, Carrington never asked for my buyer's pre-approval that they had.
Well, they won't ask for the pre-approval. So Tammy's question or statement was, Carrington, the servicer, never asked for Tammy's buyer's pre-approval. They're not going to ask for the pre-approval. Okay. When the buyer goes in to talk to the servicer, they're going to run them through the DU system on credit score and everything else to make sure they qualify. I'm just saying, as a listing agent, we would want to get that information ahead of time, because I don't want to send garbage into my seller and possibly put my deal on hold in escrow and then have this buyer that really doesn't qualify.
I did let the selling agent know that they were pre-approved. So
gotcha. So there you go. Cool. Any other questions? So here's the thing, from a listing standpoint, if you guys want to go out and get listings, now might be a great time to go out and find people that have, I'm going to run a search through my title company for 4% and under And I'm going to run it for people that probably have loans from like 2021 to 2023. And I can probably look at anything that's under 4%. And I'm going to pitch to those sellers is, hey, have you thought about selling? Did you know that you might be able to actually get more than what your house is currently worth in today's market if you would allow this new buyer to assume your lower interest rate, 4%. Hey, your house is worth 500,000. I might be able to get you 525 or 550 because ultimately, even that $50,000 more that the person's paying, the payment is considerably less. Now you have to run scenarios and look at ideas. So that's what you guys have to look at. For us in California, I know from March 22 to March 23, we actually had 11.8% reduction in prices, and we've kind of bounced back probably 5 to 6%. Someone that overpaid those $100,000 over asking prices, those people could be upside down. And they may have a life circumstance, a divorce, death in the family, transferred out of state for work, whatever. And they might say, listen, I'm actually upside down by 50 grand and I just can no longer afford my payment. A buyer could say, listen, I'm in this for the long run. I'm in this for the next 10 years. So I'm willing to take a house that's upside down by $50,000. And I know this may come as a very crazy thought process. $50,000 upside down in equity position seems like a lot. It's a weird number to even say, buy this house for $550 when it's only worth $500,000. But if I'm going to get a mortgage payment that's $1,000 a month less, in 3 years or 4 years, I'm done. I've recouped that $50,000. And based on current market trends, the market is still going up. So in 2 or 3 years, I will have paid off enough and I will have enough equity position that it really won't make a difference. So my wife challenged me on this today. She was like, why would you sell to a buyer that you're upside down $50,000? And I'm like, if they're saving $900 a month in their mortgage payment, it makes sense to me.
And they can qualify for that home, whereas they probably couldn't.
Yep. And there's no appraisal. Yep. And now they qualify for a property that they're way better off to have than what they would have gotten, in North Highlands or South Sac or whatever. So
Agreed.
just something to
Just
think
like
about.
we're looking at
Yep. Yeah.
350.
Yep.
They weren't even looking at in the 450 because they're retiring.
Okay. So can we actually hear your entire scenario, Tammy? Your clients, originally when you started working with them, were qualified at $350,000.
They were actually qualified over 800.
Oh,
So they were going to
Sorry.
be buying with their daughter.
okay.
But then circumstances changed.
Okay.
So then they went down, they were looking at 350.
So their payment that they were happy with or what they were comfortable with could qualify for, put them at a $350,000 purchase. And that was at a 6.5 or whatever it was last month or two. So now we're at 7%.
Mhm.
But they were able to buy a how much house?
$450,000.
$450,000 house. So $100,000 more. And their payment is probably pretty close to the same.
Yes. Yep.
Yep.
Except for they are a little upset that they wanted to be able to pay off the PMI insurance
Perfect. Okay.
at the end of the loan, which
Yep.
would have made their payments really where they wanted it.
Okay, so let's actually address that real quick. So currently, when you guys have anybody that's getting a loan, if they want to, they get an inheritance, they got a big tax break, they won at the lottery, whatever it is, and they want to take $50,000 and pay off a portion of their loan. We all know that when you pay off a portion, $50,000, $100,000, whatever it is, it pays off the back of the loan, right? It does not go to the overall balance, which lowers your monthly payment. So same thing in this scenario. If your clients have an extra 50 grand, they are like, hey, I have this money. I want to pay it down because I want the mortgage payment to be lower. You will not be able to do that. If you put 50,000 down, it's ultimately going to pay the back of the loan off, which would in fact bring your loan to shorter than 30 years and put it at 22 or whatever it is, right? The other thing is FHA PMI stays on for the life of the loan now. So can you go and pay off PMI? You cannot on an FHA loan. You can on a conventional loan, but conventional is not assumable. And VA doesn't have PMI.
FHA loan, like we've recasted our loan, not an FHA.
Gotcha.
So it basically, you bring $100,000 in and then it resets the payments on a monthly basis. It doesn't put it on the back end. We kept our same interest rate.
Okay, so
Recasting.
yeah,
Called recasting.
it's called recasting. And so that was the other thing I was going to say is I would probably not try and come in with that 50,000 and ask, can I get my payments lowered? I would go into the loan first, get it situated, get it in my name, get everything transferred. Then I would present, hey, I have $50,000. Can I pay this down and ask you guys to recast it? Because then it's in your name. And for your clients, that actually may be something that they would consider. But I would probably wait 6 months to like show that I'm making my payments on time. All the servicing is done properly. We've got everything adjusted. Then I would go in and ask for a
That's
recast.
really good information.
Is recasting allowed on FHA? I have never done it with FHA, so I don't know the answer to that. I know on conventional.
I actually don't know. I would just say is if I was going to approach it, I would wait till I'm situated in my loan first. I have heard of recasting happen a lot lately because people have we sold my parents' house where, you know, inheritances come in and they're like, I don't want to refi because my rate would be crazy, but I have this $50,000 I want to put down and then I want to lower my payment. And then I want to add one more thing. Think about this also. For the people that are assuming these loans, they are not 30-year loans because they've already had a year or so paid off on them. You're actually paying off 29 years or 28 years. So the savings is even greater because, you know, the first 5 years, 10 years of your loan, you're paying like 95% interest and 5% principal. So you just the 2 years or year 2, whatever it is, you're removing that from your loans. You're actually only have a 28-year loan. So another thing to pitch to your clients, your buyers is, hey, you're not having a 30, you got a 28-year. So
Good information.
I hope that helped you guys. Any questions? I'm gonna go back in. Hold on a second. I want to share my screen again. Just make sure I covered everything in my list. We got kind of moving and questions and all that kind of good stuff. So I want to make sure I didn't miss anything. So we talked about searching, talked about calling your title rep. When I didn't talk about this was text message or email when you're going out to sellers. What are the benefits to them? They could get more money for their house. Especially if they bought at the peak, they could be upside down. So those are things to think about. Similar letter to buyers, show the mortgage calculations, show them how they can get, you know, a considerable less payment, or they could buy more house. So I think I did cover everything. So very good.
Great topic.
All right.
Great presentation.
Yeah, great
Thanks.
presentation. Good job.
Thanks.
Yes.
So real quick, in 2 weeks, I think it's 2 weeks, I'm going to be teaching on a thing called Google Workspace. If you guys have never heard of it, it is something I learned about 3 weeks ago. And I have been bringing it into my my daily activities. And it is a huge, huge savings. Everybody has Google. Most everybody uses Google, Google Drive, Google Chat, Workspace, Docs, Sheets, everything. I'm going to show you guys how to utilize something, and I'm going to show you how to be able to bring people into it. The buyer side, the seller side. If you have a business partner, if you have an admin, everybody gets to see the same thing, and it has checklists and built into it. So stay tuned for that. And I think 2 weeks, Kelly will remind me if I have anything else coming up in the next week or so. And for those of you guys online, thank you for being here. You don't have a chance to win, so I'm going to turn you all off now because the people in this room get a chance to win a gift card. If you want to win a gift card, you have to show up in person. It's not worth it to come from Arizona. It's only $25. Hope you guys had a great day. Thank you for being here, and we will see you all soon. Take care.
Bye.